So for the past few months, we've taken a detour with Econ Plus Doll regarding the financial markets and the market perspective from the UK, but applicable to the US markets. Now that we've covered that, we're going to start talking about more about corporate finance again, back with Dr. Deric channel with the efficient market hypothesis.
Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to talk about efficient market hypothesis. Efficient market hypothesis, EMH. It is also called efficient market theory. EMH states that share prices fully reflect all information, which means when there is a good news, share price will go up. But if there is a bad news, share price will drop. Stocks are always traded at fair value, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. In other words, it should be impossible to outperform the market through expert stock selection or market timing. Whoever that is trying to forecast the share price to go up or down, their forecast will fail. The only way an investor can obtain higher returns is by purchasing riskier investments. However, the market is not always efficient. Let's compare the reaction of stock price to new information in both efficient and inefficient markets. Under efficient market reaction, when there is a good news, the price instantaneously adjusts to and fully reflects new information. There is no tendency for subsequent increases and decreases. But sometimes there will be a delayed reaction. It happens when the price partially adjusts to the new information. For example, 8 days elapse before the price completely reflects the new information. In other words, investors take 8 days to respond to the good news. Another extreme is overreaction and correction. It happens when the price overadjusts to the new information. It overshoots the new price and subsequently corrects. In other words, investors overly react to the good news. As such, we have 3 forms of market efficiency. First, strong form of capital market efficiency. It means current prices reflect all information, including historical, public, and private information that can possibly be known to anyone. So, there is no information that allows investors to consistently earn abnormally high returns. Even insider information is of little use. But, according to empirical evidence, markets are not strong form efficient. Second, semi-strong form of capital market efficiency. It means current prices reflect all publicly available information. So, abnormally large profits cannot be consistently earned using public information. Fundamental analysis is of little use. However, if the market is semi-strong form efficient, insider information or private information may help in making abnormal profits. But insider trading is illegal. Third, weak form of capital market efficiency. It means current prices reflect only the information contained in past prices. So, past data on stock prices are of no use in predicting future stock price changes. Technical analysis is of little use. If the market is weak form efficient, investors may make abnormal profits by conducting fundamental analysis. According to empirical evidence, markets are generally weak form efficient in most countries. As a summary, weak form includes all past information, semi-strong form includes all public information, while strong form includes all relevant information. Under strong form efficient, no investor should be able to earn abnormal return. Under semi-strong and weak form efficient, no investor can consistently earn abnormal return. If sometimes investors earn abnormal return, it's still possible. Random walks and efficient markets have some connections. Random walk hypothesis argues that stock price movements are random and unpredictable, so there is no way to know where prices are headed. Studies of stock price movements indicate that they do not move in neat patterns. It is unlikely to find a fixed pattern or equation for stock price movements. When new information arrives, prices react instantaneously to it. Since new information cannot be predicted, it would arrive at random points in time. Therefore, stock price movements would be random as well. This could be an indication that markets are highly efficient and respond quickly to the changes in the current situation. To have an efficient market, it is assumed that there are many knowledgeable investors active in analyzing and trading stocks. Information is widely available to all investors, and it is free and easy to obtain information. Events such as labor strikes or accidents tend to happen randomly. Investors react quickly and accurately to new information, causing prices to adjust. The following are the implications of EMH. First, in an efficient capital market, the transfer of assets occurs with little loss of wealth. So, when you buy or sell an investment, the loss in value will be minimal. Second, in such markets, prices reflect all available information. Thus, financial asset prices are fair prices, which means they are neither too high nor too low. Third, future market prices cannot be predicted based on available information. Fourth, stock price movements are random and unpredictable. Fifth, investors are rational, which means they receive, interpret, and react to the information in similar manner. Sixth, no one can consistently beat the market, which means it's impossible to consistently make abnormal profit. Abnormally high returns are earned by pure chance. Seventh, investments in these markets have a zero NPV. Specifically, the expected rate of return equals the required rate of return. And the expected rate of return compensates the investor for the risk borne. However, there are some common misconceptions about EMH. First, EMH does not mean that you can't make money from investments, or investments in the market are riskless due to correct price reflection. In fact, EMH will not protect you from making wrong choices if you do not diversify. Remember, don't put all your eggs in one basket. Second, EMH does mean that, on average, you will earn a return appropriate for the risk undertaken. And there is no bias in prices that can be exploited to earn excess returns. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.
Are you looking for an easy
So next we'll do term structure of the interest rates.
way to view and manage your mail and packages from anywhere, 24/7?
Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to explain to you the term structure of interest rates. First, what is interest rate? The interest rate or required return represents the price of money. This is the compensation that a demander of funds must pay to a supplier. Interest rates act as a regulating device that controls the flow of money between suppliers and demanders of funds. When the demand for funds increases, the interest rate tends to rise. Conversely, when the supply of funds increases, the interest rate tends to fall. When funds are lent, the cost of borrowing is the interest rate. When funds are raised by issuing stocks or bonds, the cost the company must pay is called the required return, which reflects the supplier's expected return. The central bank regularly assesses economic conditions. When necessary, it initiates actions to change interest rates to control inflation and economic growth. Next, let's talk about the Fisher effect, or Fisher hypothesis. The Fisher effect defines the relationship between nominal interest rates, real interest rates, and inflation rate. The nominal interest rate, or quoted rate, equals to real interest rate plus expected inflation rate, plus real interest rate times expected inflation rate. By approximation, nominal rate equals real rate plus expected inflation rate. Specifically, the real interest rate is the rate that creates an equilibrium between the supply of savings and the demand for investment funds in a perfect world. In this context, a perfect world is one in which there is no inflation, where suppliers and demanders have no liquidity preference, and where all outcomes are certain. Let's take an example. If you require a 10% real return and expect inflation to be 8%, what is the nominal rate? By using the formula, you will get 18.8%. Or by approximation, the answer is around 18%. Next, Let's look at the term structure of interest rate and the yield curves. Term structure of interest rates is the relationship between the remaining time to maturity and the yield to maturity of a bond. Time to maturity is the length of holding period of the bond, while the yield to maturity is the expected return on a bond. Whereas the yield curve is a graph that represents the relationship between the remaining time to maturity and the yield to maturity of a bond at a given point in time. There are two types of yield curve. First type, upward sloping yield curve or normal yield curve. That's when the long-term interest rate is higher than the short-term interest rate. Second type, downward sloping yield curve or inverted yield curve. That's when the long-term interest rate is lower than the short-term interest rate. There are three theories used to explain the term structure of interest rate: expectations theory, market segmentation theory, and liquidity preference theory. The first, expectations theory. This theory suggests that the shape of the yield curve is based upon investors' expectations of the future direction of inflation and interest rates. If there is an expectation of higher future inflation, investors will ask for higher interest rates on the long-term bond to compensate for risk. So, you will get an upward sloping yield curve. However, if there is an expectation of lower future inflation, investors will only need lower interest rates on the long-term bond. So you will get a downward sloping yield curve. In general, the strong relationship between inflation and interest rates supports this theory. The second, market segmentation theory. This theory suggests that the shape of yield curve is based upon the supply and demand for funds, and the markets for different maturity bonds are completely segmented. If the demand is more than the supply for short-term fund, it means more people are looking for money in the short term. So short-term interest rate will become higher. In other words, long-term interest will become lower. Therefore, you will get a downward sloping yield curve. But, if the demand is less than the supply for short-term fund, it means more people are supplying money in the short term. So short-term interest rate will become lower. In other words, long-term interest will become higher. Therefore, you will get an upward sloping yield curve. The third, liquidity preference theory. This theory contends that long-term interest rates tend to be higher than short-term rates, in which you will get an upward sloping yield curve. The reason is because investors perceive long-term bonds to be riskier than short-term bonds. If investors' money is tied up for longer periods of time, they will have less liquidity and demand higher interest rates to compensate for the risk. Simply speaking, investors will not tie their money up for longer periods unless they are paid more to do so. On the other hand, borrowers are generally willing to pay more for long-term funds because they can lock in at a rate for a longer period of time and avoid the need to roll over the debt. The following is a conclusion for interpreting the shape of yield curve. You will get an upward sloping yield curve if there is higher inflation expectation, when there is greater supply of shorter-term loans, when lenders prefer shorter maturity loans. You will get a downward sloping yield curve if there is lower inflation expectation, when there is greater supply of longer-term loans, when lenders prefer longer maturity loans. Alright, that's all for this video. Thanks for watching.